Most people think the last big wealth opportunity before retirement will look friendly. It will not. It will look messy, contradictory, uncomfortable. It will look like markets sending mixed signals, gold falling when fear is rising, oil getting more dangerous, old safe assumptions breaking down, and money moving into places the crowd still thinks are too ugly or too early to matter. That is what this kind of window actually looks like. It does not arrive wrapped in confidence. It arrives wrapped in dislocation. And the people who make the most from it are almost never the people who wait for the world to explain itself cleanly. They are the people who understand the structure while the price action still feels offensive. That is the first thing I want burned into your mind. Because if you are close to retirement, or even just old enough to know that time is no longer a toy, then this matters more than it did 15 years ago. A young man can survive a decade of bad timing and call it education. A man nearing retirement can do the same thing and call it damage. That is the difference. And it is why I take moments like this far more seriously than most people do. If you want the mother line for everything I am about to tell you, here it is. The last great wealth window before retirement does not usually come from one obvious trend. It comes when forced selling creates temporary discounts, structural change redirects long-term capital, and innovation attracts institutional money before the public understands the sequence. That is the line. That is the whole framework. Not one trade, not one hot ticker. A framework, because once you understand that framework, you stop looking at the market like a gambler looking for a tip. You start looking at it like an allocator looking for dislocation, durable demand, and early institutional flow. That is a much better posture. Most people never learn it. They spend their whole financial life responding to whatever is already obvious. That is why they spend their whole financial life late. Late to buy, late to sell, late to rotate, late to protect, late to understand. Late is expensive, especially when retirement is no longer an abstract future and starts becoming a very real date on the calendar. Now let me tell you what I see here. I do not see one story. I see three different engines moving at the same time. One is forced selling. The second is structural repricing. The third is innovation money. And if you can hold those three ideas in your mind at once, you can see why this environment looks chaotic to the crowd but highly usable to disciplined capital. That is the game. Now let me begin with the first mechanism. I call it the forced liquidation window. The forced liquidation window is what happens when large holders sell a valuable asset not because the long-term case broke, but because they need emergency liquidity. Now, that distinction matters more than almost anything else in finance, because when an asset is being sold by people who do not want to sell it, price stops reflecting pure belief. It starts reflecting necessity, and necessity is one of the most profitable things an intelligent investor can ever study. This is exactly what I believe the market has been showing in precious metals. A lot of people still think that if gold falls, the gold story must be dead. That is childish. Gold can fall for a very dark reason. It can fall because somebody with a large position suddenly needs cash more than he needs principal. That is what a forced seller is, not a philosopher changing his worldview. A stressed participant reaching for liquidity. And if you do not understand the difference between those two things, you will keep selling the right assets for the wrong reasons. Now think about what the source material was really saying. Turkey panic sold 58 tons of gold in 2 weeks. That is not a casual portfolio rebalance. That is a sovereign stress reflex. India turned into a net seller for the moment. Gulf sovereign wealth funds were taking metal out of London and pushing supply into a market that was already emotionally unstable. Again, not because the long-term case for gold was disproven, because the short-term need for emergency liquidity outranked strategic patience. That is a huge distinction, and the market usually pays people who can see it before the crowd can. Let me say this plainly. A forced seller is not delivering a sermon. A forced seller is paying a bill. That is the right way to think about it. If I own an asset because I think the world is becoming more indebted, more inflationary, more politically unstable, more willing to weaken money than to accept clean pain, then one country as emergency liquidation does not erase that thesis. It may temporarily improve my price. That is the window. This is one reason I have spent my whole life distrusting emotion-led market interpretations. Prices move for many reasons. Not all of them are beliefs. Some of them are margin calls, some of them are balance sheet problems, some of them are reserve, defense operations, some of them are political cash needs, some of them are simple survival. That is why great assets sometimes get thrown overboard in ugly moments. And those ugly moments are exactly where wealth windows often open. Now let us take this one layer deeper. Gold is not just a metal, it is a monetary referendum when central banks buy it steadily, when debt loads keep rising, when the dollar carries more pressure, when trust in sovereign discipline deteriorates. Gold remains structurally relevant whether or not the chart flatters you on a given Tuesday. That is why I say the forced selling window is so valuable. The long-term demand can remain intact while the short-term price gets discounted by the liquidations of actors who are not operating from choice. That is one of the oldest and most useful patterns in markets. And if you are still young enough to have time, it is valuable. If you are nearing retirement, it can be life-changing because by that stage, opportunities are not just about raw upside. They are about finding assets with a strong structural case at temporarily damaged prices before the final stretch of your investing life becomes a mere defense exercise that matters. Now let us go one step further. Silver sits right beside this gold story, but not in the simple way many people think. Silver is the same kind of monetary animal and a very different industrial animal. Gold is the quieter elder. Silver is the unstable younger brother. Gold gets bought because the world distrusts the measuring stick. Silver gets pulled by that same distrust and by real world industrial demand. That means silver often gets hit harder in the liquidation phase and often runs harder later when the market rediscovers both the monetary story and the industrial shortage story at the same time. That is not a promise. It is a pattern, and patterns matter. This is why I keep telling people that the first phase of a big opportunity almost always feels insulting. Good assets get sold like bad ones. The crowd mistakes necessity for meaning, and patient capital is given a better entry than the larger thesis alone would normally offer. That is the forced liquidation window. It is not comfortable, it is useful. Now let me move to the second mechanism. I call it the necessity rotation. This is what the source material was really pointing toward when it turned from gold to coal. A lot of people hear coal and immediately react with social emotion instead of investment logic. That is one reason opportunities live there. The public thinks markets are moral contests. Markets are often shortages with opinions attached, and when the world gets thrown into an oil shock, the first thing I ask is not what sounds socially approved. I ask which energy sources become economically more competitive when the expensive fuel gets even more expensive. That is a much better question. This is where coal enters, not because coal became virtuous, because oil and gas became dearer. That is the rotation, and it is an old rule. When one energy source becomes prohibitively expensive or strategically risky, capital and policy start rediscovering every substitute they previously pretended to dislike. That is how the real world works. Very few politicians admit that honestly. The power grid admits it honestly immediately. Industry admits it honestly immediately. Heavy users admit it honestly immediately. And the market admits it honestly once enough money starts moving. That is why I am not interested in whether television thinks coal is elegant. I am interested in whether higher oil and gas prices make coal economically harder to ignore. The answer is yes, if oil is pushing toward $100 and if LNG gets more expensive, because the same geopolitical stress is tightening gas flows too. Then coal does not need a public relations victory. It needs relative affordability. That is enough. And when enough of the world is forced to solve an energy problem quickly instead of cleanly, the cheapest workable substitute becomes investable, whether polite people like the sentence or not. That is the necessity rotation. This matters even more, because coal is not only a power generation story. It is also a steel story. I do not think enough investors understand that infrastructure expansion, military spending, reshoring, grid rebuilding, industrial hardening, transport networks, defense production, all of that eats steel. Steel still depends heavily on coal. You can hold a conference about green intentions all you like. A bridge still needs steel. A ship still needs steel. A defense contractor still needs steel. A rail line still needs steel. The world does not build in hashtags. It builds in materials. That is why I care about coal in this particular setup. It is hated supply meeting durable need at the same time. The broader energy complex is under stress. That is a powerful combination. And because institutional capital spent years avoiding its supply. Side investment stayed constrained longer than it otherwise would have. That is exactly how you get asymmetry. Demand pressure can return faster than supply can respond. That is where margins widen. That is where boring, ugly industries start producing beautiful returns. Not because they became glamorous, because they stayed available while the rest of the system got distracted. That is one of the deepest investment lessons I know. The crowd pays too much for what flatters it and too little for what embarrasses it. In a crisis, embarrassment can be profitable. Now let me sharpen this. I am not saying buy any coal company with a ticker and a logo. That would be lazy. I care about cost structure, debt, regulatory exposure, reserve life, export exposure, management discipline. Same as always. What I am saying is that the sector is benefiting from a structural repricing of necessity, and that matters more than the crowd's moral discomfort. The market does not pay you for sounding refined. It pays you for seeing how the world actually solves physical problems when the system gets stressed. That is the necessity rotation. It is one of the most valuable parts of this whole setup. Now let me move to the third mechanism. I call it the innovation bid. This is where the market stops looking like a collapse story and starts showing you where institutions still want growth badly enough to pay for it, even during a shaky macro period that matters a lot. Because most people assume innovation gets funded only in easy markets. That is not true. Bad innovation gets funded in easy markets. Transformative innovation keeps getting funded even when the environment hardens, because it solves real commercial problems and creates takeover value. That is what I see in biotech. Now, a lot of retail investors hear the word biotech and their eyes glaze over. Some think miracle drugs. Some think lottery tickets. Some think binary risk and insomnia. Fair enough, biotech can be all of those things. That is not the part I care about. The part I care about is the collision between the patent cliff, large pharmaceutical desperation, and AI-assisted acceleration in drug discovery. That is the structure. The source material named the number plainly. Hundreds of billions in revenue face patent expiration by 2028. That is not a nuisance. That is a giant hole in the revenue floor of major pharmaceutical franchises. And when giant franchises get giant holes in their future income streams, they do not sit politely and accept it. They start shopping. That is the bid. Not a retail fantasy, an institutional necessity. Big pharma cannot allow all of that revenue to fall away without building or buying replacement pipelines. Building takes time. Buying is faster. That is why MA heats up. That is why small and mid-cap biotech with credible platforms become takeover candidates rather than just research stories. That is why venture money flows even when the rest of the market looks unstable. Because the buyer is not optional. The buyer is compelled. That is a beautiful condition to invest around. Again, not because every biotech company deserves your money. Far from it. Because when a giant incumbent must replace a cliff in its future revenues, it creates forced strategic demand for whatever can fill that hole. That is the innovation bid. And once you add AI to the equation, it gets even more interesting. AI is not just another hype word here. It is a productivity tool that cuts cost and compresses time in one of the most expensive and time-consuming industries in the world. That matters enormously. If drug discovery becomes faster, cheaper, and more targeted, then the number of viable pipeline assets can rise and the value of promising smaller companies can increase as acquisition targets. That does not eliminate risk. Biotech will always carry risk. Clinical failure exists, regulatory delay exists, binary events exist, but risk alone does not disqualify a sector. It means sizing and selection matter. That is different. And if institutional money is flowing in because the commercial need is real, then I pay attention, not because I expect every position to work, because I know where the higher order capital is being forced to search for future value. That is what matters. Now let me take this one step further. The patent cliff creates one kind of forced buying, AI creates another kind of optimism. And if those two things meet in a stressed macro world where much of the market is still emotionally defensive, then biotech becomes the exact sort of place where quiet big money can build positions before the public feels safe enough to care. That is the innovation bid, and it belongs in this framework because the framework is not about one kind of opportunity. It is about understanding how different kinds of money move for different reasons at the same time. That is the whole genius of the setup. Now let me bring the three engines together so you can feel what the source was really hinting at. Forced selling in precious metals creates a temporary markdown in assets whose long-term monetary case still lives. Structural repricing in energy makes ugly necessity sectors like coal economically more attractive than the crowd emotionally wants to admit. Innovation capital and strategic acquisition need create a funding tailwind for biotech while much of the market is still thinking only in fear. Do you see what this means? It means we are not living through a simple fear trade. We are living through a multi-layered rotation in which one part of the market is being sold because large holders need liquidity. Another part is being revalued because physical necessity has changed the price of substitutes. And a third part is attracting capital because long-term commercial need is overwhelming short-term market discomfort. That is extremely valuable. Because once you can see those layers, you stop thinking like a person looking for one hot sector. You start thinking like a person mapping how institutional pressure creates three very different openings. That is a much higher level of investing. Now let me give you the fourth mechanism. I call it the pre-retirement asymmetry. This is the reason this setup matters so much more than ordinary market noise if you are not 25 anymore. When you are younger, you can survive a lot of confusion. You can buy the wrong thing and recover. You can miss one window and still have time for another. You can afford educational pain. If you are nearing retirement, or even just old enough to realize that the number of truly great capital windows in your remaining investing life is probably limited, the situation changes. Now the asymmetry matters. You do not need dozens of brilliant ideas. You need a few strong ones and the discipline not to waste them. That is why I keep using the phrase last big wealth opportunity before retirement. Not because I think this is literally the last trade anyone will ever see, because the next decade matters differently when time is no longer infinite and when the regime is already shifting. A person approaching retirement cannot afford to spend the whole window hiding in emotional cash and then re-entering once every index is back near its highs and every asset has already recovered. That is not prudence. That is paying retail price for confidence. Confidence is expensive. This is why the current setup matters so much. It offers a chance to build or defend serious wealth in a way the next clean bull market may not, because this one is occurring during dislocation, and dislocation is where the spread between price and value gets large enough to matter. That is the asymmetry. If you are close enough to retirement that the next 10 years will define the standard of your later life, you should care deeply about windows like this. Not because you need to gamble, because you need to stop treating every fearful environment as something to simply endure, and start recognizing that certain fearful environments are actually the only times future compounding gets offered at terms worth your attention. That is the distinction. Now let me give you the fifth mechanism. I call it the layered allocation rule. This is how I would think about acting without becoming reckless. First layer is monetary dislocation. That means precious metals exposure, where the selling pressure is coming from. Force liquidators rather than thesis collapse. Second layer is structural necessity. That means energy substitutes and related assets, where the physical world is repricing the usefulness of supply. Third layer is innovation, backed institutional flow. That means selected biotech. And for many people, perhaps sector funds, rather than single names, where the patent cliff and AI-driven discovery are drawing serious money. That is the allocation logic, not all in, not one trade, a layered response to a layered opportunity. This matters because a lot of people hear about a window and immediately want one perfect answer. Markets almost never work that way. The better answer is usually a structure, something that gives you different forms of exposure to different types of asymmetry. That is what this setup offers. Now let me say something hard. Most investors will still miss it. They will miss it because they will treat the precious metals sell-off as proof the thesis died. They will miss coal because it offends their preferred story about how the world is supposed to transition. They will miss biotech because it looks too complex or too risky compared with doing nothing. And then 5 years from now, they will tell themselves the people who acted were simply lucky. Number, they were structured. That is the real difference. Now let me make the identity flip explicit. Most people think the point in a market like this is to be brave. Wrong. The point is to be framework-driven. Brave people do stupid things all the time. Framework-driven people do selective things. A brave fool buys anything red because it looks cheap. A framework-driven investor asks what kind of money is moving, why it is moving, and whether the move is temporary dislocation, structural repricing, or innovation demand. That is a very different brain. A brave fool thinks one good call will save him. A framework-driven investor knows that a handful of asymmetric exposures, sized correctly and understood clearly, can matter far more than one emotional swing at the fence. Those are different people. The market pays them very differently. Now let me give you the sixth mechanism. I call it the dry powder test. This is where people sabotage themselves. A real opportunity is only useful if you still have enough liquidity, enough emotional stability, and enough room in your finances to actually take it. That is the dry powder test. If your life is so overbuilt that every market drawdown becomes a personal emergency, you will never use opportunity correctly. If your portfolio is already so concentrated that you cannot add intelligently, you will never use opportunity correctly. If your emotions are so tied to short-term validation that you need the market to reward you immediately, you will never use opportunity correctly. That is why preparation matters. The market is only half of the equation. Your structure is the other half. I care about that a lot. Cash reserves, position sizing, no reckless leverage, room to average in, room to wait, room to survive looking wrong temporarily. All of that matters more than people admit, because the people who capture these windows are not usually the loudest. They are the people with enough internal and financial reserve to keep acting while the world is still arguing with the setup. That is the dry powder test. Pass it, and the window is usable. Fail it, and the opportunity exists only for somebody else. Now let me give you the seventh mechanism. I call it the compounding handoff. This is where everything becomes more meaningful. The compounding handoff is what happens when one temporary dislocation becomes the base from which the next 10 years of wealth are built. This is why I care so little about whether the market gives you immediate applause. The first bounce is not the point. The point is what kind of cost basis and income stream you are handing to your future self. If you acquire real assets, real businesses, or real sector exposure at materially better prices during a dislocation, and then allow time to do the heavy lifting, you are not merely trading. You are handing your future self a stronger engine that matters enormously. A good entry into a long-term metal cycle matters. A good entry into structurally repriced energy necessity matters. A good entry into innovation flow before the public wakes up matters. These things are not just one-year opportunities. They can change the slope of your next decade. that is the handoff. And if you are close to retirement, that handoff may matter more than any short-term win you could possibly chase. Now let me say something even harder. A lot of people overestimate the importance of being right about what happens next month and underestimate the importance of being positioned for what becomes obvious over the next 5 years. That is backward. The next 5 years pay more always. Now let me bring this all together into an operating system first. Separate foreselling from broken thesis. That alone will save you from countless stupid decisions. Second, look for structural shifts created by physical necessity, not public opinion. Third, follow innovation money where commercial pressure is real, not where the crowd is merely excited. Fourth, size your exposure so that volatility does not force you out of the very setup you entered for the long term. Fifth, keep enough dry powder and personal stability that the window remains usable. Sixth, think in decades, not days, once you identify a real mispricing cycle. That is the operating system, not prediction, positioning, not excitement framework, not hoping prepared action. That is how serious money behaves. Now let me put the blade into this as cleanly as I can. The biggest mistake ordinary investors will make in this setup is thinking these are three unrelated stories. They are not. They are three expressions of the same truth. Capital is moving away from easy assumptions and into dislocation. Necessity and innovation, that is what the window really is. Gold and silver are showing you what forced selling looks like when the long-term case still survives. Coal is showing you what structural repricing looks like when the physical world stops caring about the crowd's preferences. Biotech is showing you what institutional demand looks like when future revenue replacement and AI acceleration combine. That is the map. And if you remember nothing else from what I said, remember this. The last big wealth opportunity before retirement rarely looks like one clean trend that everyone agrees on. It looks like several ugly, early, contradictory moves that only become obvious in hindsight. By the time they feel neat, the money is already moving. Use that now or watch it later. But do not pretend the market did not offer the window when the structure was already there the whole time.